The first trading day of the new year off to a rough start, with the Dow down almost 400 points right now.
Weaker than expected manufacturing data out of China helped trigger a global sell-off of stocks, sending jitters through Japan, Europe, and here in the United States. China's Shanghai Composite dived nearly 7% before trading was stopped altogether. And escalating tensions in the Middle East did more to spark the downturn. Let's get straight to Belpointe Chief Strategist David Nelson. He joins us on the phone now. David, explain further what some of those key factors abroad are contributing to this side.
Well, there's a few. You talked about the main one right at the top. This sell-off was triggered really starting in China. There was a trading halt. Their markets were down close to 7%. It was on the heels of weak economic data there, and then it just kind of spread around the world. It hit Japan next, the rest of Asia, translated to the shores of Europe, and now it's here in the United States as well. But it's not the only reason the markets are down today. There was, geopolitical chaos, certainly in the Middle East. Saudi Arabia and Bahrain both breaking off diplomatic ties with Iran. And anytime you get a geopolitical event like that, it creates uncertainty, and markets don't like that. Hence, we're seeing a pretty big sell-off today.
What does this mean for U.S. investors? How worried should we be?
That's a good question. I talked earlier about it. I don't want to sugarcoat it. China's it's the second largest economy in the world, and destined to eventually become the largest economy in the world. And I know it seems like a huge surprise because everybody looked at the basic indices last year, and most of them were about flat. But when you scratch beneath the surface, it was really worse than that, because the average stock in the S&P 500 was probably down last year. And as a matter of fact, 20% of the stocks in the large indices are in a bear market and have been, and they're down more than 20% from the highs. It's a rolling correction that started last year. It's not all bad news. Look, we go through times like this. There are certainly some bright spots in the economy. I think the consumer is in better shape than most think. They may not be shopping in the malls, but they're certainly buying automobiles, and they're certainly spending a lot online.
So let's ask this question, and Caroline, you were just sort of talking about it as far as how this will impact U.S. investors. We can probably expect, David, to see some portfolio weakness if you've got 401ks, if you've got 529 plans for kids in college. But for the American consumer, they're still going to be buying Apple products. They're still going to be going to Starbucks. What kind of effect will this have in real time over the next couple of months here in the United States for people?
Broadly speaking, you're hitting it on the head. People aren't going to stop going to Starbucks, and they're going to probably do the things that they normally do. I don't think that we're heading into any kind of economic recession here in the United States. I think stocks are weak for a variety of reasons. One, they've been pumped up a lot by the Federal Reserve for a number of years, and probably ran further than they should have. There was excess liquidity in the market. And CEOs were using that excess liquidity to buy back a lot of stock, and that drove stock prices higher. The FANG stocks where everybody hid, and those are companies like Facebook, Amazon, Netflix, and Google. Everybody's taking profits in those today. So we're seeing extra weakness in the market because these big-name stocks are being hit hard. I think, broadly speaking, if you have a 401k, whatever your asset allocation is that you arrived at for a long-term, portfolio, you're probably not going to change it on a one-day event like this. At least you shouldn't anyway.
All right, you mentioned it's not all bad news for consumers, but how surprising is the China slide?
When you wake up in the morning and you see markets down pretty hard, especially on the first trading day of the year, I guess it catches you off guard. But in retrospect, you look back, it's probably not that surprising. China has unwound several bubbles over the last number of years. Certainly the commodity bubble and oil has come down precipitously, largely on the heels of lack of demand from China. But like you said earlier, customers aren't going to stop going to to Starbucks, and they're not going to stop going to Home Depot if they're building out their house. So It always hits us in the face. It's like a slap of cold water, but, we wake up the next day and we start going through this one stock at a time and buying what we should.
Hey, David, yeah, and that's the question I was going to ask you before I let you go. Now, market down 365 points represents a buying opportunity for the smart institutional investor. If they love the stock that they loved yesterday or on Friday or before the trading day opened, they got to love it even more. So could we see a bounce in way in some portfolios as people buy in the weakness?
Well, we're off the lows of the day. The lows of the day, hit a few hours ago. And we've been just kind of slowly scratching our way higher. I think how we close the day is probably more indicative of the sentiment right now. And just like you said, it's a two-way market. Yeah, there's a lot of selling going on, but there's a buyer on the other side of every one of those sales. So some of the people that step in today might look pretty smart a couple of days from now.
All right, David Nelson, thank you very much. Appreciate it.